The long-term foreign and local currency issuer default ratings of the states of Kaduna, Kogi, Lagos and Oyo have been raised by Fitch Ratings. The outlook for all four states is still stable, according to data on the agency's website. According to the agency, the rating move comes after Nigeria's sovereign rating was upgraded from a B- to a B on April 11, 2025, indicating better macroeconomic stability and policy reforms. Now, following the delisting of 4 companies, the Nigerian Exchange Limited reported a net market capitalization loss of 25.27 billion naira in the first quarter of 2025. There were no new listings throughout the review period, and the exits were motivated by a combination of regulatory enforcement measures and strategic corporate decisions. Joining me now to discuss this further is Arise business analyst Chika Mbonu. Mr. Chika, good morning to you. How are you today? Very well, thanks.
Welcome to a new week.
Yes, a new week. Let's get a new start. Let's begin with the recent ratings upgrade for Kaduna, Kogi, Lagos, Oyo states. How significant is this move in terms of investor confidence in Nigeria's state-level economies?
Well, the first thing I want to say is that it's not surprising because your father can be rich and then you're poor. It doesn't work that way always. The logic, because of the fact that the federal government sovereign rating of Nigeria has been upgraded. I mean, before this has slot now, you had the Minister for Finance and the CBN governor, pushing that narrative out, singing it like the national anthem, that Fitch has moved Nigerian rating from -B to B, which is like stable. And so the individuals make up the total. So the states make up the Nigeria, and usually what happens is that when the sovereign rating is upgraded, that's for the states that feed from the federal government also upgraded, and that's what you're seeing. And the other thing also is that it's rarity for the states to have superior standalone ratings, than the sovereign. Yeah. In this case, among the states they rated, only the state that has a better rating than the federal government of Nigeria is actually Lagos State. And it's not too far-fetched the reason for that. If you start from the states, Kaduna State, 86% of their revenue, of their debts are foreign debts. Yeah. So despite the upgrade from -B to B, there's still a lot of vulnerabilities that have been identified with those states. And basically, for something like Kaduna State, 86% of the debt is still foreign debts. And you know what happens with that? The exchange rate, moves, the quantum of the debts also move. And just like we talked about the macroeconomic stability of Nigeria, which is good now, but the issue again, remember, we'll say also that if the oil sneezes, Nigeria will catch a cold. And despite what we're celebrating now, if oil prices tank, going to have problems with the macroeconomic stability, exchange stability that we have achieved, and so on and so forth. And everybody is talking about it in the sense that, what are we going to do in the long term to sustain the ratings? So for the states, as I said before, the importance of these ratings that they can go out there and get debts. Foreign investors or other investors can come in there and say these states are good places to give money or to invest in. And so good for them.
All right. Can we make any long-term projections, or is it just safer to play within the short term, especially when it comes to broader economic environment, which you've highlighted cogently just now?
The problem with doing this is that, as I said before, most of them are plugged into the federal government of Nigeria. Yeah. And we've done some things in the program, in this program in the past, where we analyzed all the states and said the states make their revenues from 2 sources: internally generated revenues, called IGR, and the FAC allocations, the one that come from federal government, they share monthly. Principally, the VAT proceeds and oil and gas, oil revenue proceeds, which they share monthly. Now, the majority of that comes from oil revenues. And apart from Lagos State, most other states, the average in Nigeria for the IGR is about 25% of the total revenue. Mm-hmm. The other ones come from the federal government. The federal government is what? Oil proceeds. So the issue, therefore, is that they have a problem with the oil revenues coming in, or VAT revenues coming in. Downstream, all the states will be affected. The one only state that really, not immune substantially from this is Lagos State. So if you want me to project down the line, I will ask you always, like I said in this program, that Nigerian economy is too very easy to analyze. Just look at the direction of the price of oil.
Absolutely, we have a real domino effect. If we just, it makes it so much easier. Let's look at the NGX next.
Okay,
For companies delisting, what can we attribute this to?
Now, companies go to the NGX, Nigerian, exchange, for principally major reason is to go there to be able to raise money, to do their projects. Equity capital is known as cheaper than debt and other things. That's the major reason. Now, the major attraction. But also, like every club, you're going to have minimum qualifications to continue to belong to that club. To belong to NGX requires a lot of discipline. Principally, including the fact that the corporate governance must be solid. The other thing includes the fact that there are minimum times, latest times for you to file your annual reports or other information required by investors to transparently deal with your stocks. Yeah. If investors don't know what's happening in your stocks, in your company, you don't publish your reports on time, how would they buy your stocks? So that's one element. So there are rules there that have said, if you don't submit your reports like this, after several warnings, it can be delisted. So that's one of the reasons why some companies have actually been delisted. They failed to meet the qualifying requirements, required to continue to be members of the NGX. And so each time they're delisted, you find that their total capital, is also removed, and that's why you are seeing the calculation they're doing. The other type of delisting is intentional delisting, where especially the foreign-owned companies, where they have substantial core holding, and those companies have found out that now the major advantage of going to the market, listing the exchange, is to raise money. And that advantage does not exist for them again. They have alternative ways of doing it. So in that case, they say, why belong there? Every year, paying the fees and other compliances that are expensive to maintain, vis-a-vis the value we're getting from belonging to the exchange. And so they corporately dictated the decision that it's not worth a while again to continue to be in the exchange. Now that's the next level of delisting that you have seen. Again, those bundle up together make up the amount that you have seen that have said the valuation of the exchange has reduced by that amount.
And in many ways, those are legitimate concerns, right? Of course. But how does this affect investor sentiment and market liquidity? You've alluded to some of these already.
But the good thing is those that are intentionally, they deliberately exit.
Yes.
They always, require procedures that must be complied before you can take your stocks out of the market. And you can't just dump any price on the investors. There has to be valuation. And the
process has to be followed.
And a lot of times the investors get good deals. So if the going rate maybe 10 naira now, usually there's a premium added on top of for the investor, for the majority to buy off the minority. And so there are always a lot of good deals. And there have been instances where the majority who want to delist a company have made offers, and the SEC and the NGX have said, no, this can't fly. There are instances like that. So there's a lot of transparency on that. But for the other one also, those that have been forced to exit, that's why it's also important for investors to continually keep an eye on the market, refer to their brokers or advisors to let them know which stocks they should put their money in and those which they should exit. So, but it's not good news when companies are actually forced out of the market because of non-compliances, because investors lose.
It certainly isn't. And of course, transparency and process is always good and welcome. Insightful as always. I want to thank you, Mr. Chika, Mbonu, for joining us. We'll see you again tomorrow.
Thank you.
Right?
Yes.
All right, then.